Okay, so suretyship, we will discuss it today. So, what is the suretyship? How is it happen? And what are the liabilities in this case of creditor, debtor, and surety? And what are the rights and defenses are available here? So, first of all, if we talk about what is suretyship, so basically it is a legal relationship wherein one party, which is often called surety, is guaranteed the performance, debt, or obligation of another party to a third party. So suppose A and B party are come into some legal relationship, like someone has given the debt to A has given the debt to B, or B has given the debt to A. So in this case, A and B are having some creditor or debtor relationship. But if a third party comes into play, like C party comes into action and it guarantee the debt of one party. Okay, if suppose A has given the loan to B and C is acting as a surety in this case, like it is giving the guarantee that B will pay the debt to the A, otherwise the C party will pay the debt. Okay, or if B not pay, the C will pay. So this is a legal relationship that where one party guarantee the performance, debt, or obligation of the another party to a third party. Okay, so it provides the financial protection to the creditor if the principal fail to fulfill the obligation. So principal is basically the party who has taken the loan, who has taken the debt, and the here basically this kind of relationship gives the creditor the financial protection that if in case the principal will default, then he has the right to go for this surety uh, to uh, to take his loan to take his principal amount back. Okay, so next is key characteristics. So three party relationship here. So principal basically who owes the obligation, surety who basically guarantee the obligation of this principal, creditor basically who gives the debt to the principal or who basically receive this guarantee. Okay, so liability of surety here is liability generally secondary. So generally the liability of the surety is secondary, means if the principal like first primary liability is related with the principal who has the obligation to pay, but in case if he do not pay, then the surety has the obligation to pay. It becomes primary on default. So if the principal default, then it is the completely primary responsibility of surety to pay on the behalf of the principal. Okay, sometimes it is equal to the principal. Okay, so sometimes there are some like types of arrangement in which the surety has secondary liability, means it will only liable if the primary party default on the loan. But there are some arrangement in which this surety is equally liable, means he also has the primary responsibility, primary liability to pay even if principal doesn't default on the loan. Okay, strictly governed by surety contract terms. So if we compare suretyship with insurance, so basically surety ship involve three people relationship, whereas insurance involve two parties. Surety expect reimbursement, means like if he is paying on behalf of principal, then he can expect the reimbursement from the principal. But in case of insurance, insurer expect losses. Suretyship require the principal to indemnify the surety Insurance has basically two parties, whereas suretyship has three parties. If we talk about consideration, so consideration need not flow to the surety directly. Consideration between principal and creditor is basically sufficient. So there is no required consideration is required here. So for example, ABC borrows 10 lakh from PQR bank. So here ABC is the principal party and PQR is the creditor. So bank require a guarantor, means who can guarantee this debt on behalf of this principal. So Mr. Raj sign as surety here. So if this principal party default, then bank has the right to demand the full repayment from the surety, who is Mr. Raj here. Okay. So if Mr. Raj pays this amount on behalf of ABC, then he has the right that he can recover this amount from the ABC party. Okay. So when a surety pays the amount on behalf of the principal, then he has the right that he can take his payment, he can ask for repayment from the principal. Okay, so that means he will come under the shoes of creditor after he gives the payment on behalf of principal. Any doubt till here? Any
No.
doubt? Okay, so next is suretyship. This surety's right. So what are the rights of surety here? So right of subrogation. Subrogation means here, like if the surety pays the debtor obligation, then he comes into the shoes of creditor, as I as just discussed. The surety acquire all rights the creditor had against the principal debtor. Okay, so basically he becomes the creditor now, who has the right to take his amount from the creditor. Okay, so this right include right to collateral, so he can take some asset as collateral from the creditor, from the principal. He guarantees or any legal claims. Okay, so suppose here Mr. Raj if pays the amount of ABC. So now the role of PQR bank has ended here because they have taken their money back from the surety here. So now this ABC now offs the obligation to Mr. Raj. So Mr. Raj now can here act as a creditor and can ask for money from ABC now because he has paid on behalf of ABC. Okay, so after paying the debtor's obligation, so this surety has all the right that is associated with the creditor. Okay, is it clear?
Yes.
Next is right of reimbursement. So reimbursement means the principal debtor must reimburse the surety for any payment made on their behalf. So it is the liability of the principal that he should reimburse the amount to the surety if he is paying on his behalf. This right exists even there was no express contract. So even if it is not explicitly stated, there is no as such contract, but still it is the obligation of the principal that he has to pay back to the surety. Debtor must return the full amount paid plus expenses. Okay, so debtor has the obligation to pay this full amount. Also, if there are any expenses, he should pay. So if a surety pays 1 lakh to settle a debtor's default, the debtor must repay the surety this amount. Okay. Next is the right of exoneration. So exoneration means the surety can demand the debtor to perform their obligation before the surety is required to pay. So suppose since surety has guaranteed the debt of debtor, but he has the right that he can ask the debtor to pay for his debt, okay, before the surety is required to pay. So it is available when the debt is due and the debtor is able to pay. Okay. So if someone comes to the surety and asks for repayment, then he has this right that he can first go to the debtor and ask that you should pay to the creditor. Okay, so it is the right of a surety. So a creditor demands payment from a surety even though the debtor has sufficient fund. Okay, so here the debtor has fund, but still creditor comes to the surety. So in this case, surety has the right that he can force the debtor that he should pay the amount to the creditor. Okay, is it clear?
Yes.
Okay, so next is right to contribution. Right to contribution means like if there are multiple sureties are existed. Okay, so in this case, each surety must contribute proportionately. So suppose this 1 lakh is paid by 3 surety here. Okay. So whatever the amount they have paid, they need to be divided this proportionately among different surety. Okay. So right to contribution state that when multiple sureties exist, each surety must contribute proportionately. So suppose they are paying some $150 to the creditor. So there are three surety here. So even if one surety is paying $150, then this 150 should be divided among these three sureties. Okay. So if one surety party pays more than their share, then they may recover these from co-surety. So if suppose you have three sureties here, A, B, and C. Your A has paid $150 on behalf of your debtor. Now he has the right that he can claim this $150 from this B and C. So if we proportionate among three, then each will have $50 in their proportion. Okay, so A has the right that he can claim this 50 and this 50 from B and C. Okay, so that his obligation will his contribution becomes $50 now. Okay, is it clear? Three sureties guarantee 90,000 equally. So one surety if paying the full amount, then he can recover this 60,000 from the other party, other surety. Is it clear? Is it clear? Any doubt?
Yes. No.
Okay, so next is right to defenses. Right to defenses means the surety may use any defense available to a principal debtor. So, except personal defenses like debtor's bankruptcy discharge, surety may assert their own defenses like fraud, misrepresentation. Okay, so what are the various defenses that is available for a surety? So, so they can use various defenses. If underlying contract is void, the surety is not liable. So what are the defenses that a surety can use means how he can escape from this obligation. So there are some of the defenses which we will discuss in the later slides. So here one example is given that if the contract is void means if it was something related to your illegal matter or something which make the contract void, then in that case your surety has no liability to pay on the behalf of debtor. Okay. So here are some of the defenses that are available to avoid or you can use to reduce your liabilities. So first are defenses available to both debtor and surety. So what are the defenses that both are debtor as well as surety both can use in their defense? So first is lack of consideration. So a suretyship require valid consideration. So if there is no valid consideration is involved, That means there is no valid contract, and due to which they can use it as a defense to escape their liabilities. Okay. Next, fraud or duress by the creditor. So if the creditor is threatening the surety or the debtor, or if the creditor is using is doing some certain kind of fraud, so in that case your debtor as well as surety use this defense to escape from the liability. Okay. Illegality of the contract means if the underlying obligation is illegal, then surety is not liable. So if we talk about lack of consideration, X agreed to act as surety, but creditor gives no new consideration. So that means suretyship is void. So this defense can be used by both debtor and as well as your surety. Next is if the creditor lies about debtor's financial condition. So if there is certain kind of fraud is involved, or certain duress means creditor is using is threatening or doing some physical harm, so in that case you can use this defense as a to escape from the liability. Next is illegality of the contract means like if your underlying obligation is illegal, so in this case the surety is not liable. Example, a surety cannot be held liable for guaranteeing payment of illegal gambling debt. Okay. Next is incapacity of the debtor. So if your debtor lacks capacity, like someone is minor, mentally incompetent. So if someone who has taken the debt from you is a person who is minor or is mentally incompetent, then in that case the obligation is void. So it means your debtor as well as surety both can be discharged by using this defense. So is it clear or any doubt? Is it clear or any doubt?
Clear.
Clear, ma'am.
Okay, so next are the defenses that are only available to surety. Means surety can use this to escape from the obligation. So first is this defense is basically related to the action of creditor that increases the surety's risk. So first is the release of principal debtor. So if creditor releases the debtor without reserving their rights against the surety, then surety is discharged. So if the principal debtor is already releases by the creditor, so in that case your surety can use this defense to escape from the liability. Next is modification of contract without surety's consent. So if material alteration is made uh, without informing the surety or without their consent, so in that case your surety can be discharged from this liability. Next is impairment of collateral. So if creditor negligently handle or releases collateral, surety is discharged to the extent of impairment. So if creditor negligently handle or releases the collateral, so if the debtor has taken some asset, has put their asset as collateral to the creditor, and creditor are like handled it collateral negligently or destroyed it or released the collateral, so in that case your surety is discharged up to the extent of the impairment. So whatever the loss has like occurred, so up to that loss amount or impair amount, your surety is discharged from that obligation. Next is creditor's failure to notify surety of debtor's debt default. So if the debtor default on the loan, so there is a notice which is required under the agreement. But if creditor failed to notify the surety in the required time period, and after that they come to the surety and ask for payment, then he can use this defense to escape from liability. Next, creditors misrepresentation to the surety. So if there are any misstatement that influences the surety to enter the agreement, it will result in the discharge. Okay. Is it clear?
Yes.
Okay, next is surety's personal defenses. So personal defenses, first is bankruptcy of surety. So for example, like if someone has guaranteed the debt of another people, okay, surety has guaranteed the debt of debtor. But in case if surety itself become bankrupt, so in that case, he can escape from his liability. So if the surety is personally bankrupt means can be discharged through personal bankrupt only for surety's obligation, not the debtor's debt. Okay, so whatever the amount the surety has guaranteed about debtor, then that amount can be avoided by the surety. Okay, so in case if he becomes bankrupt. Infancy or incapacity of surety. So if the surety is a person who is actually minor, incapacitated, or contract may be voidable, so in that case your surety can use this defense to escape from the liability. So for example, debtor and creditor modify loan terms by increasing interest rate without the surety's consent. Okay, so here the surety is discharged. So in this case, your surety is not informed about some modification, so it can use this defense to escape from the liability. Next example is given that creditor releases collateral without informing surety. So again, there is the release of collateral. So in that case, your surety is discharged to the extent of impairment. Next is debtor was a minor when the contract was signed. Okay, since here your debtor is a income has lack of capacity, so that means the contract is void, and here your surety also don't have any liability. Okay, is it clear?
Yes.
Okay. Okay, so next topic. Creditors right outside of the suretyship. So what are the various right of creditor here? So first is garnishment. Garnishment means a legal process that allow a creditor to collect a debt by seizing money or property in the hands of third party. So garnishment basically allow the creditor to seize the property of debtor that is being held by the third party. So suppose if the debtors some property of debtor is in the hands of some third party. So as a creditor, you have the right that you can go for that property and seize them to take your money back. It is commonly used to garnish wages and or bank account. Debtor must be given notice and an opportunity to object. So you can't directly go to the third party and give take their property. But first of all, you have the duty that you should give a written notice to the debtor. You should inform the debtor and give them an opportunity that to object means that they can comes to you and give their money back. Otherwise, you will seize their property. So bank garnish $20,000 from a debtor's salary each month until a loan default is satisfied. Okay. So next is attachment. Attachment means it is basically a prejudicial remedy in which a creditor is allowed to take possession of personal property of debtor prior to getting a judgment for the past due debt. So court order that basically allowed the creditors to seize debtor's property before judgment to prevent the debtor from hiding or disposing of the asset. So what happened? A debtor can hide or dispose of their asset so that it cannot be taken by your creditor. So in order to prevent this, the creditor has some right in which they can seize the debtor's property even before they goes to the court, okay, before the judgment, in order to prevent the debtor, because debtor might hide these assets so that they do not have to give them back to the creditor. Okay, often used when the creditor fear that debtor may abscond, means debtor may hide these properties. So, for example, a creditor attaches the debtor's car before the trial to ensure availability for the execution later. Is it clear? So, attachment is basically a court order. Next is judicial lien. Judicial lien means a creditor may obtain a lien on debtor's property after winning a lawsuit. So the lien allows the creditor to force the sale of the property to recover their debt. So this is also the right of creditor that he can take possession on the debtor's property after winning a lawsuit. So if the he wins the case against the debtor, so he has the right that he can take possession of the property that is belongs to the debtor. Okay, so the lien allows the creditor to force the sale of the property, that he can even sell the debtor's property in order to receive their money back. So after a court judgment, the creditor record a lien on the debtor's land and begin foreclosure proceedings. Next is mechanic or artisan lien. So it is basically granted to individual who provide labor or material improving someone's property. So this type of right is given to the individual who basically provide labor or material improving someone's property. So if someone is providing their labor, like someone is doing work on someone's property or they are providing some material, the lien gives them the right to retain the property until the payment is received. So for example, a mechanic repair a vehicle and keep it until the repair bill is paid. Okay, so for example, your mechanic repair, so if someone has repaired your vehicle and you're not paying them for these repairs, they have the right that they can keep your property until you take their money back. Okay, so next is the composition of creditors. Composition of creditor means an agreement between insolvent and multiple creditor to accept a lesser amount in full settlement. So it is basically the agreement. So when debtor is not able to pay his obligations, so he may contract with the creditors to have a settlement in some lesser amount. So binding only on the creditor who agrees. So for example, creditor agree to accept 60% of outstanding amount. So 40% he is ready to give up. Okay. Assignment for the benefits of creditor. So the debtor voluntarily transfer property to a trustee who liquidate it and distribute proceed among the creditor. So basically what happens here, the debtor give their property to someone else, the third party like a trustee, who basically liquidate that property, and whatever the amount proceed they are getting from that property is distribute among the creditors. Okay, so it is a faster and cheaper than bankruptcy, but not court supervised. For example, a small business assign all its asset to a trustee to avoid bankruptcy proceedings. Any doubt?
No, ma'am.
No.
Next is fraudulent transfer. So fraudulent transfer here, the transfer made with intent to hinder or defraud creditor can be reversed by the court. So both actual and constructive fraud are covered. So if someone has tried to defraud creditors, so they have the right that they can go to the court and court can reverse this transfer. Both actual and constructive fraud, both are covered here. Okay. So debtor gives a property to a relative for rupees 1 just before a creditor's judgment. The court can void the transfer. Okay. So if creditor is transferring their property to someone else, okay, so that they do not have to pay to the creditor, or so they do not have to give this property to the creditor. So since this is a fraudulent act which is intent to hinder or defraud the creditor, so in this case the court has the right that they can void this transfer. Okay, so this property can be given to the creditor and this transfer can be considered as void. Next is exempt property. Exempt property means some of the properties which can be exempted. Okay, so which can prevent some of the properties of a debtor to be seized by the creditor. For example, some basic household items. So these are necessary to the debtor. So these can be prevented from seizing by the creditor. Tools of trade, sometimes a portion of wages, some personal medicines. So, for example, creditor cannot seize the debtor's essential household appliances or personal clothing. So, these are some of the rights that is creditor's right outside of the suretyship. So, first we discussed about garnishment. So, garnishment basically gives the creditor the right that he can seize the property which of the debtor which is in the hand of third party. Next, attachment. It's state that like if you can seize the property of debtor even before the court judgment is given, so that a creditor is not able to hide that property. Judicial liens state that a creditor may have the option to lien on debtor's property, so they can seize the debtor property and sell them in order to recover their debt. Mechanical or artisan lien means like if someone is providing some labor to the other party and that party is not able to pay them, so they have the right that they can take their property in their custody until they pays to them. Composition of creditors said that like if debtor is not able to pay, then debtor and creditor can do some agreement, so that agreement in order to have the settlement in somewhere in less amount. Assignment for the benefit of creditors means like if debtor can transfer their property to third party who sell them on their behalf and give the proceeds to the creditors. Fraudulent transfer means like if a debtor is involved in some fraudulent transfer in order to prevent their property from seizing. So in that case, your court can void that transfer. Okay. Exempt property means some of the property which is exempted from the creditor claims, like household items, some useful like things like household item, trade, tools of trade, sometime a portion of wages, clothing, medicines. So again, your judicial lien is given. So judicial lien is a legal claim basically on a debtor's property which is guaranteed by court to secure a payment of debt. So it arises after creditor wins a lawsuit and obtain a judgment against the debtor. So if the creditor has win the case and they got the right that they can go for debtor's personal property. So it attaches to real or personal property Creditor may force the sale of property to satisfy the judgment, or priority depend upon the date the lien is recorded. Okay, so they can go for debtors' personal property, they can seize them, they can sell them, so that they can recover their amount back. So, for example, a creditor sues John and wins 20,000 judgment. The creditor records a judicial lien on John's land. So, if John tried to sell the land, then lien must be first uh, paid first from the sale proceed. Okay. Next is garnishment. So, garnishment here is a legal process where the creditor collects debt by ordering a third party, usually an employer or a bank, to withhold money which is belonging to the debtor. So, here the creditor go for the third party who has the custody of some of the money of the debtor, so they can request to them that they should withhold that money on their behalf. Like wage garnishment, like employer withhold the wages of an employee if the employee default on certain loan. Bank garnishment means fund frozen and transferred to the creditor. Example, Mary offers a credit card company $5,000. The creditor obtains court order for garnishment. So Mary's employer is ordered to withhold 15% of her salary until the debt is paid. Okay. Any doubt?
No.
Okay, next is mechanical and material strength liens. So this type of lien basically protect individual and businesses such as contractor, subcontractor and supplier who provide labor or material to improve the real property. Okay. When the property owner fail to pay, these parties can claim a lien on the improved property. This lien serve as security interest ensuring the payment. Okay, so if someone is providing you labor or material on your property, then they have the right that they can claim certain amount on the improved property in case if you do not pay them. Who can claim this lien? So basically it can be claimed by contractor, subcontractor and construction worker, material supplier who deliver building materials, professionals such as architect, engineers or designers. What are the requirement for this valid lien? For the lien to be valid, the first is the claimant must provide labor, material, or services that improve the real property. Okay, so any of the people can't basically claim the property. So person who actually providing labor or material or services, they have the right. The work must be authorized by property owner or general contractor. The claimant must file a lien within statutory time, means often at 30 to 120 days after the work is performed. A proper notice must be given to the owner. So these are some of the requirements for a valid lien. Next is the effect of the lien. So mechanics lien encumbers the properties, preventing sale or refinancing until the debt is settled. So it gives the claimant the right to force a sale of the property through the foreclosure if the payment is not paid. Okay, so as I told you that they have the right on that property if the payment is not made by the debtor. Priority of mechanics lien is usually from the date the work started, not the date the lien was filed. They may have the priority over mortgages or other claims. So if the debtor has some other mortgages or some other claims, so in that case, your mechanic lien can get the priority as compared to the mortgage and other claims on the debtor. Okay. So ABC Construction build a boundary wall on Mr. John's property. The cost is $20,000. John refuses to pay after completion. ABC Construction files a mechanic lien within 60 days of finishing the work. So a company was building certain property. The cost comes here is $20,000. This property belongs to Mr. John and he refuses to pay to the construction company. So they can have the right that they can file mechanic lien within 60 days. As a result, John cannot sell the property. So even if he sell the property, then he has to first take back take this money to the ABC construction. So if John still refuses, ABC can take legal action to foreclose the property to recover the amount. Is it clear?
Yes, ma'am.
Next
Yes.
is fraudulent conveyance. Conveyance. Meaning of fraudulent conveyance here is when debtor transfer property within with the intent to hinder, delay, or defraud creditor. This transfer becomes voidable by the court. It means creditor can challenge them and have the property to brought back into the estate. So as I discussed earlier, that sometimes what the debtors do, they can try to secure their property so that it do not seize by the creditor. So in order to secure the property, they may transfer their property to someone else, they are near and dear, at some lower amount, so that this property their the ownership basically transfer to another people and this property will not be seized by the creditor. So in that case, if the transfer involves some fraudulent activity like to hinder or defraud the creditor, so in that case this transfer can be considered as void. So two types of basically fraud can be involved. Actual means when there is complete intention, there is actual intention to do uh, behind this transfer. Constructive fraud means the transfer without receiving reasonably equivalent value and debtor become insolvent as a result. So here, what are you doing? You're selling your property to very low amount so that you can become insolvent and nobody comes to you and ask nobody like no creditor can comes to you and ask for their payment. So this is called the constructive fraud. What are the indicators basically which show this kind of fraud? So transfer to an insider or a relative. So if someone is transferring their property to relative, transfer is made when sued or threatened with lawsuit. So someone has filed some lawsuit or threatening you. So in this case, your transfer is like made at that time. Debtor retain possession or benefit after the transfer. Transfer of substantially all asset. Consideration usually low. Debtor becomes insolvent after the transfer. So these are some of the indicator which may indicate the fraud. So what are the remedies that are available to the creditors? So creditor may avoid the transfer. They can recover the property or its value, obtain injunction to prevent the fraud, further transfer. They can pursue damages against the transferee who knowingly participated in the fraud. So if this kind of things are happen, then creditor has the right. Then they can challenge this kind of transfer. They can recover the property or its value. They can take official order means injunctions means official order from the court to prevent further transfers. Okay. For example, Mr. A of 20 lakh to creditor. So they have obligation of 20 lakhs. Knowingly he will soon be sued. He knows that he will be sued by his creditor. So in order to protect himself, he gift his house worth 50 lakh to his brother for rupees 1. So this is a fraudulent transfer. So creditor can file an action to void transfer and recover their property. Okay, is it clear?
Yes.
Okay, so next is Fair Debt Collection Practices Act. So the name itself defines that fair practices should be involved to collect your debt. So it is a federal law designed to protect consumer from abusive, unfair, or deceptive debt collection practices. It regulates how third-party debt collector may contract and interact with the debtors. Okay, so that nobody able to use abusive, sorry, unfair or deceptive debt collection practices in order to recover their debt back. So basically, purpose here is ensure ethical debt collection, protect consumer from harassment and false representation, provide legal remedies for violation. Who is basically covered under this act? It applies to third party debt collector. So if there are some collection agencies, attorneys collecting debt for clients, so they are covered under this act, means they has the obligation that they should follow these rules and regulation in order to recover the debt. Original creditor are generally not covered unless their uses are different business name. Next is prohibited practices. So harassment or abuse. So if someone is threatening, obscene scene or language or repeated calls. So if they are abusing in some manner, so they are prohibited from doing this kind of act. False or misleading representation, like claiming to be a law enforcement, misrepresenting the amount they owe, so this is also prohibited. Unfair practices, like if they are using unauthorized practices, like collecting unauthorized fees, deposit post-date check early, so these are some of the activities which are prohibited under this act. Okay, communication rules means like cannot call before 8 a.m. or after 9 p.m. So it stated that you can't basically communicate in this time period. Cannot contract debtor at work if employee prohibited personal calls. Must stop contracting if debtor request in written, like except for a legal notice. Okay. Validation of debt means collector must send written validation notice within 5 days of first contact. So collector, if you are a collector, you must have to send the written validation notice within 5 days of first contract in order to recover your amount back. Notice include amount of name of creditor and right to dispute the debt. Any doubt?
Yeah.
Okay. Remedies for consumer here. Consumer may sue collector for damages. So what are the remedies that can be available to consumer? Means like debtors basically. So they can sue collector for damages. So if the collector has done some damages to them, so they can recover this amount back. Sorry, they can sue them to cover their damages. They all collector also liable for the attorney fees and court costs. So these expenses can also be claimed from the collectors. ABC Collections repeatedly calls Joan 15 times a day, uses threat, and refuses to send a written validation notice. So Joan can file a lawsuit under FDCPA Act, okay, and may recover statutory damage plus compensation for emotional distress. Okay, so if collector has like done some kind of uses some kind of threats to use some kind of abusing language, so they as a customer, you have the right that you can go for court and uh, claim your damages, also compensation if any for the emotional distress. So any kind of harm if you have faced, you can sue them. Okay, is this clear? Any doubt in this topic, suretyship? So we discussed suretyship here. So what are the various rights that can be available to the creditor, that can be available to the debtors? Any doubt?
No, ma'am.
No.
Okay, so our next topic is secure transaction. We will discuss it tomorrow. So please revise up to here and do practice some question. We will also do in our next class.
Okay, ma'am.
Okay, then thank
Okay.
you for joining.
Thank you. Bye bye.
Bye.
Thank you, ma'am. Bye.
Bye.